Okay, let's get started on section 1.4. So to recap, up until this point, we've been talking about the different markets. We've been talking about the different institutions that are part of those markets. And we've been talking about the regulators that oversee these markets. One of the big regulators is the Federal Reserve, but they do that through monetary policy. And so that's what we're going to talk about in section 1.4. Okay, we're going to get into that right now. So in this section, we'll explain the meaning of monetary policy. We'll identify the dual mandate of the Federal Reserve, explain what is meant by hyperinflation and how it can occur, and we'll discuss why deflation, price deflation, can be problematic for the economy. So monetary policy is defined simply as the management of the money supply and interest rates by a central authority. The interest rates is probably the bigger component of that in today's environment, but that's what the Federal Reserve is charged with. In the United States, the authority for monetary policy is the Federal Reserve System, the Fed. So the flow of money is deeply linked to two major economic variables, which is employment levels and inflation. So the Fed uses monetary policy to steer the economy towards stability. We'll talk about exactly what that means, right? So the United States Congress, when they created the Federal Reserve, has given them what is known as the dual mandate. The goal of the Federal Reserve is to achieve maximum employment and maintain stable prices. So when we talk about maximum employment, we don't mean zero employment. Unemployment. When we talk about maximum employment, we don't mean zero unemployment. Economists acknowledge that there's always going to be a certain level of churn as people move between jobs or they enter into the workforce for the first time. There's always going to be people out there who are putting out their resumes, looking for work, who are unemployed but looking. The goal isn't to eliminate all of those. The goal is to reach the desired level of employment that exists under normal economic conditions. We consider a 4% federal unemployment rate to be pretty good. And we've been at that for the last couple of years. I'm recording this in 2025. It's September 25th, 2025 right now. I'm hoping these videos last about 5 years. So some of this may be a little bit dated by the time you see it. But the federal unemployment rate for the last couple of years in the recovery of the pandemic has been around 4%, 4.1, 4.2, maybe 4.3 today. We're in a situation right now where the labor market is softening a little bit. Unemployment rate is ticking up a little bit. And the Federal Reserve is watching that very closely, and they're adjusting. They just adjusted their first interest rate of 2025. They decreased it by 25 basis points. That may not mean anything to you right now, but it will hopefully mean something to you as you improve, as you continue through your education. But the purpose is the Federal Reserve wants there to be stable employment, and as many people who want a job should be able to find a job and get a job. There's always going to be some level of people who are looking for work. If that's 4% of the population, of the working class population who are looking for work, that's pretty good, right? If it's 3%, that's incredibly good, and maybe actually a little scary. If it's 6% or 7%, that's high, and that's a problem. We don't want unemployment to be that high. So they have to balance that and look for that desired rate. Same with the price stability, right? Stable prices are equally critical here for both individuals and for businesses so they can plan effectively for the future. You need to be reasonably certain that the purchasing power of your dollar is not going to drastically change over time. So when the Fed believes the economy is kind of sluggish and slowing down, for instance, it might pursue what's called expansionary monetary policy, where it increases the money supply, pushes more funding out to the market via lowering interest rates. By lowering interest rates, you make money cheaper to borrow, and that stimulates output and employment at the same time. So we target about 2% rate of inflation. Inflation is the change in the value of how far your dollar goes, how much your dollar can buy over time. So we like to have a 2% annual inflation rate. Right now, in September 2025, we're hovering about 3%. So it's a little high. From 2 to 3 may not sound like much, but it is a lot, and it's a little high. And we want that to come down back to about 2% inflation. But it's been high since the pandemic. For the last 5 years, it's been high. And mainly because of supply chain shocks And those supply chain shocks have been met with price increases because demand is high, but supply is low. And then so companies are taking price increases. And then many companies who took price increases from their manufacturers or their suppliers, they added on to that price increase with their own price increase because not only did they want to pass those costs on, but they also wanted to take advantage of the price increase to boost their own bottom line. So we've seen pretty high inflation over the last 5 years, and that's something the Federal Reserve is very cautious about, and they adjust their interest rates appropriately to combat high inflation or high unemployment. That's their dual mandate. So price stability is a tricky goal because the economy needs to avoid extremes. Instability in the form of either rapid inflation or the opposite, deflation, can have deeply harmful effects on economic performance. Now, to be clear, when I talk about hyperinflation, what we had in the last 5 years was not hyperinflation. It was high, but not hyper. Hyper means like your dollar's like worth something today and then not worth hardly anything the next day. Like hyperinflation is a very different thing. We're talking about the severe extremes. We haven't really experienced a lot of this in the United States, but other countries have. So when we talk about severe inflation, meaning an annual rate of 10% or 20% or even higher than that, well, that changes people's economic behavior. Consumers are going to become anxious because their incomes are not going to keep up with the rising costs, and it makes future planning pretty much impossible. So what people do to protect their wealth, some individuals start stockpiling goods, buying large quantities now rather than waiting for the higher prices that are going to come tomorrow. You have a lot of people in the economy now who are preppers. You know, they're buying stock, they're stockpiling food and well, a lot of things. And it's because they're fearful of, you know, an economic catastrophe. So they buy large quantities now rather than waiting for the higher prices tomorrow or for instability in the markets. Other people might just abandon the traditional banking system, and instead they're going to, you know, heavily invest in non-cash items that still steadily rise in value, like precious metals, land, even rare art is a form of an investment, gold, silver, things like that. They may even resort to bartering for services because if money's worthless, if it's becoming worthless more and more every day, well, it may make more sense to go back to a bartering system in those countries. So some businesses might thrive, like debt collection agencies or credit card providers. The overall economy with a hyperinflation environment is going to become very distorted, and it's pretty disastrous. So the most disastrous form is hyperinflation because that's a severe inflation that's taken to an uncontrolled, rapid extreme. You could be up in the thousands of percentile increase in value or decrease in value of money. The other danger, which is also disruptive, is deflation, which is where you have a general decline in prices for goods and services. When prices start to come down, you might think that's amazing, that's great, but it actually has some pretty harmful effects on the economy in the sense that it slows things down and can plunge us into a recession. So looking a little bit more closely at hyperinflation, hyperinflation again is defined as a rapid and completely uncontrolled inflationary spiral, death spiral basically, where prices are rising by 50% or more per month. And this has happened, but not here in the United States, but it has happened. It's usually caused when governments attempt to finance massive budget deficits, often resulting from war or political upheaval, by printing huge quantities of new currency. The government's just making a money machine. They're just printing money left and right. So here you've got a table of countries that show just how quickly money can become worthless under hyperinflation. In Hungary in 1946, prices were doubling every 15.6 hours. More recently, in 2008, Zimbabwe, the prices were doubling approximately every 25 hours. We have lots of examples of this kind of economic catastrophe. The German economy collapsed after World War I, which was largely due to hyperinflation. The government then financed its post-war needs by printing so much money that prices increased by more than 1 trillion% between 1922 and 1923. So you can imagine the chaos of that. Business owners couldn't conduct rational planning. Workers demanded wage increases multiple times a week. Some Germans even resorted to just burning their worthless paper currency because it was cheaper than buying firewood. And so the result was massive unemployment and economic destruction, and a rise of a political party that said, we're going to do something about that, which then led to World War II. A more recent example is Venezuela, where they were very dependent on oil exports and high government borrowing, and they ended up printing money that caused an annual inflation rate to peak at 65,000% in 2018, which led to shortages of food and medicine and the mass immigration of millions of citizens. So while hyperinflation receives the most dramatic headlines, the opposite of that, deflation, is extremely damaging to the economy as well. It may sound great, prices are coming down, cool, but in the reality, it's not a good thing. So first, remember, the Federal Reserve's dual mandate requires it to promote both maximum employment and stable prices. So when stability is lost, you have pretty severe problems. With hyperinflation, that's the rapid, uncontrolled scenario where prices rise 50% or more per month. But with deflation, that's a general decline in prices for goods and services. So, sounds great, but deflation is harmful because it devastates people who borrow money. Borrowers must repay their debts with money that is now worth more in terms of purchasing power than the money that they originally borrowed. That dynamic hurts those who invest or speculate on the prospect of rising prices, and it often leads to foreclosures and bankruptcies. The Great Depression provides an American example of deflation's destruction. Following the stock market crash of 1929, prices declined sharply, and this price decline led directly to lower profits for companies, which forced them to then lay off workers, which then drove unemployment. More people who don't have jobs looking for work who cannot find it. And so the unexpected price declines actually fueled a downward spiral, brought the economy to a halt, harmed the borrowers, people who had mortgages, people who couldn't pay for their mortgages, and it led to the failure of thousands of banks across the country. It was devastating. So we don't like hyperinflation, we don't like deflation, we don't like these extremes. All right, so we spent this section talking about monetary policy and how it interacts with the economy. In the next section, we're going to wrap up this chapter by talking about some of the careers that are available in the money and banking and financial institutions. So I'll see you in that one.